Ladies and gentlemen, thank you for standing by and welcome to Supremex Inc.'s fourth quarter and fiscal year 2019 earnings conference call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during the session, you'll need to press star 1 on your telephone. If you require any further assistance, please press star 0. I would now like to hand the conference over to your first speaker today, Danielle Sainte-Marie, Investor Relations for Supremex. You may begin your conference.
Thank you, Julianne. Good morning, ladies and gentlemen. My name is Danielle Sainte-Marie. I'm an independent advisor and act in investor relations capacity for Supremex. With us today is Stewart Emerson, President and CEO, and Guy Pronovo, Chief Financial Officer and Corporate Secretary. I would like to welcome you to today's conference call to discuss our financial and operational results for the fourth quarter ended December 31, 2019, which were released earlier today, as well as the recent acquisition of Royal Envelope. This call will be held in English. J'aimerais vous rappeler que cet appel est tenu en anglais. For more detailed analysis of our results, please see our financial statements, our management discussion and analysis, and our press release disclosed earlier this morning and available on the company's website and on SEDAR. In addition, we posted a presentation supporting this conference call, which is available through the webcast and on our website. I would like to remind listeners that this conference call contains forward-looking information within the meaning of applicable Canadian securities laws, and I refer the audience to the forward-looking statement as detailed in the presentation supporting this conference call. Furthermore, risks and uncertainties are discussed throughout the December 31, 2019 MD&A under the heading Risk Factors. Unless stated otherwise, all figures are expressed in Canadian dollars. During this call and on the accompanying presentation, we use various non-IFRS measures, including adjusted EBITDA. These terms are also defined in our MD&A. With these formalities out of the way, I would like to turn the call over to Stewart Emerson, President and CEO at Supremex, to review this quarter's key operational highlights and recent events. Stewart?
Thank you, Danielle, and welcome everyone. During 2018 and 2019, we invested significantly in our packaging operations in order to raise capacity and capabilities. These were good investments in our future, but they were short-term material drains. Durabox has been a real challenge. If you recall, we were pretty ambitious with our expansion plans. We moved from 37,000 square feet to 144,000 square feet over the past year. We actually increased both our capabilities and our capacity significantly. Unfortunately, the ramp-up has been much slower and costlier than expected. After more than 6 months of a very steep learning curve, we have been self-sufficient on the corrugator since June of 2019 and have capacity available. Unfortunately, as soon as we got through the issues on the front end of the operation and started to stress the back end, we started having material issues on two of the 3 lines. We limped along through the balance of 2019 and into early 2020. These challenges caused serious inefficiencies, outsourcing and R&M costs, and forced management to temporarily essentially abandon the sales growth process. We have rebuilt 1 line and the second line has been repaired to a reliable state. We're not completely out of the woods yet, but the new management team has done an excellent job. We are producing well and think we'll have cleared our backlog by mid-March, at which time we can focus on selling the available capacity and executing on the original business case. Folding carton was also an unexpected drag on earnings in 2019. The primary culprit was the decommissioning of an old and the commissioning of a new press at our Montreal facility. The combined inefficiencies, increased waste, and R&M, along with significant outsourcing costs, were a sizable drag. Add to that some turmoil associated with integration and ERP implementation. These issues at Durabox and Folding Carton, in addition to the loss of the above-mentioned e-commerce customer, explains the 4.3 million shortfall in adjusted EBITDA versus 2018 in our packaging and specialty products segment. The fundamentals of both of these businesses remain good. The folding carton business was without its moneymaker for essentially 25% of the year and struggled staying focused with distractions. The corrugated business simply took much longer to ramp up than we could have reasonably expected. We changed the management, paid the penalty, and are ready to move forward. We are disappointed by the outcome, but I'm encouraged by what I see and what I'm living. We have put considerable effort into rectifying the challenges. I don't foresee additional material CapEx required in either of these businesses, and I believe the personnel changes we have made and are making are the right ones. On the e-commerce side, we are making steady progress and have had 3 good wins in the last couple of months with subscription-based e-commerce customers in the oral hygiene, shaving, and eye care space, and have several other really interesting projects on the go. After the letdown of the large customer that we have talked about for a few quarters now, it finally feels like we have some wind at our back. U.S. envelope is doing exactly what we need it to do. It is driving volume, activity, and efficiencies to the Canadian plants as the Canadian secular decline continues at a rate in excess of the U.S. decline. Units produced in Canadian plants for U.S. affiliates were up 27% year over year, which is an increase in excess of what we managed from 2017 to 2018. The role will take on even more importance as a result of the Royal Envelope acquisition. By conservative estimates, by combining the entities, producing in local markets, and taking advantage of the efficiencies associated with ganging runs, we believe we can increase the available capacity by up to 10 to 15% with the existing manpower. As a result, we have a full court press on U.S. volume. On the Canadian envelope front, there is no surprise that we continue to feel the effects of secular decline. Volumes were down 12.6% in 2019, which is roughly in line with the 11.3% transactional mail volumes declines experienced at Canada Post during the last quarter. That said, we posted above expected revenue and earnings by improving mix, passing through delayed raw material increases, tightly managing costs, and through the effects of Project Canada restructuring from Q4 2018 and Q1 of 2019. Although the Canadian envelope market continues its secular decline, these operations remain a key and steadfast contributor to our profitability and cash flow generation. As an important part of our strategy, earlier this week we announced the acquisition of Royal Envelope, which we are confident can be quickly integrated and will immediately generate top and bottom line synergies. About Royal Envelope, the company had $30 million in revenue in the last 12 months, primarily in Eastern Canada. It employs 135 people and operates primarily out of a 56,000 square foot facility in Concord, Ontario, with a small operation in Lachine, Quebec. Royal Envelope is a Tier 1 supplier known for quality products and good service. They have a modern fleet of equipment and some capabilities and competitive advantages that Supremex had not invested in. We paid $27.4 million, and their profitability margins are roughly in line with ours. The rationale is fairly straightforward. The North American envelope market remains challenging and continues to face secular decline. We require additional scale to help us deliver cost-effective products to both the Canadian and U.S. markets. Not surprisingly, given our size and geographical proximity, there are some attractive cost synergies available to us. The unique capabilities and capacity from the Royal assets are necessary to support the growing needs of our U.S. organization. Supremex had allocated the majority of its capex over the last couple of years to the aforementioned packaging projects and was getting to a point where we needed to do several machine updates or upgrades over the next few years. And when we did the analysis, buying the equipment from Royal versus new or from a broker helped justify a good portion of the acquisition cost. In the current tight labor market, this transaction provides access to high-quality skilled labor and strong envelope human resources throughout the business. Adding the equipment, employees, and know-how from Royal to the Supremex platform helps us remain relevant to envelope employees, customers, and suppliers over the longer term. We have an impressive track record in integrating envelope operations. We have a deep talent base from which to draw, and the business itself is well run. Our intention and expectation is to do exactly what we achieved when we concluded the 2015 acquisition of Premier Envelope in Western Canada. We increased operating rates, improved our Western Envelope division's margins, and freed up capacity, setting the stage for our growth and diversification strategy into the U.S. market and then subsequently into packaging. We expect the Royal acquisition will do just that. Yes, the acquisition of Royal Envelope is an offensive play in a declining market, but it will help protect our market share and bottom line, providing the means and resources to improve our cash flow generation capabilities and provide additional cash flow to continue executing our diversification strategy. With this, I'll turn the call over to Guy for a quick review of our financial results for the fourth quarter and fiscal year ended December 31st.
Thank you, Stewart. Good morning, everyone. Fourth quarter total revenue was $49.2 million, down 9.2% versus Q4 2018. Revenue from the envelope segment stood at $35.8 million, down 6.8% or $2.6 million compared to the fourth quarter of 2018. Canadian envelope revenue was $23.9 million, down 7.3% from $25.8 million in the fourth quarter of 2018. Canadian envelope volume declined by 14.2%, primarily resulting from the combined effect of industry-wide secular decline, customer movement, and the company's strategy to maintain a disciplined market approach with price leadership and differentiation. Average selling prices increased by 8.1% to mitigate the effect of significant input cost inflation that occurred throughout 2018 and in the first half of 2019. Revenue from the U.S. envelope market was $11.9 million, a decrease of 5.7% versus Q4 2018. The volume of units sold decreased by 7.1%, while average selling prices increased by 1.5%. Packaging and specialty product segment revenue stood at $13.4 million, a decrease of 15% compared to the equivalent quarter of 2018. The majority of the decline results from the loss of business with an e-commerce customer and from weaker revenue in the folding carton division. Packaging and specialty products represented 27.3% of the company's revenue in the quarter, down from 29.2% in Q4 2018. Fiscal 2019 total revenue was $191.7 million, a decrease of 1.8% versus 2018. Revenue from the envelope segment was $137 million, down 0.8% versus prior year. Canadian envelope revenue was down 3.3% to $91.7 million from a volume reduction of 12.6%. During the year, we managed to increase average selling prices by 10.6% to help mitigate input cost inflation. U.S. envelope revenue increased by 4.8%, reaching $45.5 million compared to $43.4 million in 2018. The volume of units sold decreased by 2.7%, while average selling prices increased by 7.7% to offset rising input costs. Average selling prices were impacted by a positive foreign exchange translation effect of approximately 2.4% from a weaker Canadian dollar when compared to the equivalent period of last year. Packaging and specialty product segment revenue decreased by 4.1% to $54.5 million. The loss of volume from a single e-commerce packaging customer was partly mitigated by higher folding carton sales from the acquisition of G2 Printing. Moving on to earnings, fourth quarter adjusted EBITDA was $5.4 million compared with $8.1 million in the equivalent quarter of 2018. The decrease of $2.7 million stems primarily from the lower contribution from the packaging and specialty product segment. Fourth quarter 2019 adjusted EBITDA margins were 11% of revenue compared with 15.1% in the equivalent quarter of 2018. Envelope segment adjusted EBITDA was $5.8 million in the fourth quarter, down from $6.1 million in 2018. Lower contribution of the U.S. operation was mitigated by a slight improvement of operating profitability of the Canadian envelope operations. Envelope segment adjusted EBITDA margins stood at 16.2%, up from 16% in the fourth quarter of 2018. Packaging and specialty products segment adjusted EBITDA was $0.3 million, down to $1.7 million versus Q4 2018. Operational inefficiencies in folding carton was the largest contributor to the reduction in operating profitability, followed by inefficiencies from the slower than anticipated ramp-up of the new Durabox facility. Packaging adjusted EBITDA margins were 2.4% compared with 12.9% in the equivalent quarter of 2018. Fiscal 2019 adjusted EBITDA was $20.2 million, down from $26 million during the equivalent period of 2018, primarily from lower contribution from the packaging and specialty product segment. Adjusted EBITDA margins stood at 10.6% compared with 13.4% last year. Envelope segment adjusted EBITDA was $20 million, in line with 2018. Envelope adjusted EBITDA margins stood at 14.6%, slightly up from 14.5% in 2018. Packaging and specialty product segment adjusted EBITDA was $2.7 million, down from $7 million in 2018. Operational inefficiencies at the folding carton division was the largest contributor again to the reduction of operating profitability, followed by inefficiencies related to the ramp-up of the new Durabox facility and the loss of volume with an e-commerce customer. Packaging adjusted EBITDA margins were 5% compared with 12.4% in 2018. Fiscal 2019 net earnings were $7.1 million, or 25 cents per share for the 12-month period ended December 31st, 2019, compared with a net loss of $4.8 million, or 17 cents per share in the equivalent period of 2018. Net cash flows from operating activities were $20.2 million in fiscal 2019 compared with $11.9 million last year. The improvement is mainly attributable to the impact of IFRS 16 and to a 2.5 million reduction in inventory. On February 20th, 2020, the Board of Directors declared a quarterly dividend of 6.5 cents per common share, payable on April 15, 2020, to the shareholders of record at the close of business on March 31st, 2020. This dividend is designated as an eligible dividend for the purpose of the Income Tax Act and any similar provincial legislation. I would now like to turn the call over to analysts for questions. Operator.
Thank you. As a reminder, if you would like to ask a question, please press star followed by the number 1 on your telephone keypad. We'll pause for just a moment to compile a Q&A roster. Your first question comes from Neil Linsdell from Industrial Alliance. Your line is open.
Hey, good morning, guys.
Morning.
Obviously, you've had a lot of challenges with some of the growth, some of the ramp up with the new facilities and such. Can you just rehash though the headwinds that you're having both on the envelope and the packaging side? I'm trying to figure out with the customer loss, the e-commerce customer losses on the packaging side and the customer movement that you talk about on the envelope side. When can we expect to be past these headwinds, and what kind of normalized growth or declines on the envelope side should we be thinking about going forward?
So there's no customer movement on the envelope side. It's all secular that we're facing. So there's nothing on that side that's material. Then you've got the addition of the Royal Envelope side, which kind of changes market share. On the e-commerce side, that we're through customer number 1, if you will, decline. We've gone through our full 4 quarters after Q4, so we're past it. We had too much customer concentration in the e-commerce side. I mean, our first win was a big win, and ultimately, I mean, it helped a lot on the upside, but it hurts a lot on the downside as well. We'd like to have a customer concentration more in line with what we have on the envelope side, where no one customer is more than 5% of our total sales, but just the way it played out.
Okay. Well, going back on the Canadian envelope. So I'm just reading through the press release here, and you do talk about the volume decline being from the secular decline and customer movement. Was that customers that maybe moved over to Royal Envelope, and now you've gotten back with the acquisition?
Well, there's certainly some of that with the acquisition, but most of that played out in 2017 and 2018. I think what we're talking about in the press release is sort of normal ebbs and flows of customers moving around. There wasn't anything material or any major customer that bounced. We're all kind of sitting here looking at one another, saying, "What was the customer in Canadian envelope?" But it's more the ebbs and flows.
Yes.
Okay, fair enough. Thanks for the clarification. And now with the acquisition, obviously you've got your new credit facility. You've taken on some increased debt due to the acquisition of Royal. So how do you feel now with your leverage ratios, your debt level the way it is now? Is there going to be a focus on paying down the debt, or are you going to be investing more in growth, more on the packaging side?
So we actually addressed that in my closing comments.
You were speaking very quickly. I missed some of it.
No, my closing comments after you're finished, after your question.
Oh, sorry.
But I mean, we can jump ahead there, no problem whatsoever. I mean, our capital projects are mostly completed, and we really don't see any other significant investments in equipment or being required. And until sort of profitability margins demonstrate consistent improvements, we don't intend to conclude any major acquisitions until such time as we get the other 2 businesses turned.
Okay.
CapEx,
is there anything?
Maintenance CapEx. Sorry.
No, go ahead. Finish.
Maintenance CapEx will sort of be in consistent with previous years, $2.5 million.
Okay. Anything specific on the pharmaceutical side on that packaging after you bought G2 and the PharmaFlex labels, or have we seen any like really positive opportunities come in or anything on the horizon?
No, and frankly, the challenges are primarily around the original business, the cosmetic business, and there's a few things there. One was the press, and there's been a switch in customer preferences from one raw material to another, which squeezes margins a little bit for the manufacturers. But there's been no big wins, a couple of losses on the cosmetic side, but nothing like e-commerce.
Okay. And then just finally, with the Royal Envelope acquisition, I don't think there's much expected from costs associated with any of the integration or in restructuring that's going to happen as you integrate those two businesses, I believe. And I think can you talk about when or how you're going to start seeing synergies between the business in a little bit of detail?
Well, interestingly enough, we actually moved a major order from Toronto to Montreal yesterday. I've talked to all of the major raw material suppliers. So those synergies are playing out immediately. And we're actually producing, Royal Envelope also, sorry, I missed that spot, but Royal Envelope also purchased $2 million outside of the Royal family last year from other envelope companies, a little bit including Supremex. That $2 million can be immediately insourced as opposed to outsourced. So, I mean, we're on it right away. We've got an integration team embedded in the Royal facility as we speak, and they're pushing orders around, taking advantage of the purchasing opportunities. And you're correct. I mean, there's no sort of major costs associated with integration. I mean, the operation here in Montreal is very, very, very small. And the Toronto operation is quite large and very efficient. And there's no sort of consolidation thoughts there or anything along those lines.
Okay. Just actually one more. Royal Envelope, did they have much business out in Western Canada that you're now going to be able to serve much more efficiently, or was it mainly in the East?
Low double digit.
Okay.
Percentage.
Okay. Thanks. That's it for me.
Thanks, Neil.
We have no further questions. I turn the call back over to presenters.
Sorry, operator. Do we have one more question? Do we have another question?
We do have a question. It's from Jason Whitting from Invesco. Your line is open.
Sure. Oh, hi, guys. Thanks. I just had a few follow-up questions on the Royal acquisition. When you said margins are in line with what you guys do, is that with respect to the company overall or for the envelope division specifically?
Envelope division.
Okay, perfect. And then if you look at the cost synergies to revenue synergies, whatever, in 2 to 3 years' time, do you expect what's going to be the bigger number, the revenue side or the cost side?
I'm not sure how to answer that one, Jason. I mean, we have significant cost synergies that we can take advantage of. The sales side, I mean, the market's not growing, market's declining fairly rapidly, but we're going to take that excess capacity and we're going to blow it into the U.S., which is at a lower margin than the Canadian business. So, I mean, there's so many pluses and minuses there. I just don't know how to answer the revenue question.
Yeah, no, the revenue one's definitely the harder one to guess. And then on to that U.S. comment, did Royal sell anything into the U.S. currently?
$137,000.
Okay, so not much. Yeah, okay. Perfect. And then just maybe the last one on Royal, just on the price paid. it looked a touch higher than sort of on a price to sales or EV/EBITDA basis based on some of the deals you guys did in 15, 16. So maybe just a little bit about how you got to the price paid.
All right. Well, in our case, of course, we ran scenarios as far as building this business, the synergies that we would get from the acquisition. But we feel, actually, I wasn't here when we did the other acquisitions you're referring to, but in this case, the multiple is, we have a more reasonable multiple because it's a business in secular decline, of course. So we're looking at a more reasonable multiple. If you factor in the synergies that we are planning for in our models, it's actually a very, very reasonable multiple for us.
Okay, yeah, Jason,
yep.
Sorry, Jason, just the other thing on that, when we talk about, I mean, you're drawing some inferences on sort of Canadian envelope is more profitable than our overall envelope segment. So you can
right. Okay. Yeah, that's helpful. Yeah, and again, I just compared it to your price of sales to some of the ones you did in the past, Classic or Premier. Some of those ones looked a little lower, but maybe that margin difference could explain it. So yeah, no, that's all I had. Thank you very much.
Actually, that would explain it very much. Yes.
Okay, so thanks guys for your questions. Just in conclusion, we intend on the packaging side is to really leverage our capital investments to raise the margins. We entered the year with close to 28% of our revenues from packaging and specialty product sales, and we remain committed to our long-term goal of achieving a 50-50 revenue split between envelope and packaging. Obviously, that stretches a little further now with the addition of Royal Envelope's $30 million. We intend to ensure we successfully integrate Royal. This is what we do well. On the capital allocation front, we remain committed to bringing down our leverage by consistently and continuously reimbursing debt. Our capital projects, as we talked about earlier, are mostly complete. We don't expect any other significant equipment to be required in 2020. The maintenance CapEx should be in line with previous years in the $2.5 million range. Our profitability margins demonstrate consistent improvements. We do not intend to, until they demonstrate consistent improvements, we don't intend to conclude any additional acquisitions. We strongly believe in the businesses, but are disappointed that our packaging divisions have taken so long to capitalize on the investments of time and capital. That said, we're positioned operationally to grow across all three lines. And as I said in last quarter's remarks, we have great assets, the infrastructure is in place, and it's now time to leverage those investments by getting out in front of customers and selling. This completes my closing remarks. I look forward to meeting again on this call to discuss our first quarter results and at the AGM in May. Thank you very much and have a great weekend.
Ladies and gentlemen, this concludes today's conference call. Thank you for your participation. You may now disconnect.